Welcome back to the SMS Health and Wealth Studio. Today, I'm John Summers, joined by Brandon Aldi. We're going to talk a lot about retirement refinance. We're going to unpack that title. What does that mean? And we're going to tell you why right now is the right time to be in the annuity market, as well as having this conversation with our clients. So 2024, hard to believe it's more than half over. We're on the back nine, so to speak. We are having what looks like will be a record year for senior market sales when it comes to many product line sales, but mainly annuity sales. And a lot of our advisors are having record years as well. And I think a big part of that is because of this concept that we brought to the table. So, Brandon, maybe before we get into it, we're going to talk a little bit about retirement refinance. And has that helped you a little bit with some of your conversations that you're seeing with our top advisors?
Absolutely. And so the concept itself, John, is something we've been talking about for a while, right? I remember kind of post-COVID, we were at broker-dealer conferences talking about annuity reallocation, reevaluation processes, policy reviews. So it's not a foreign concept to the producers that we work with. I think what's driving the conversation now is the interest rate environment, right? We have product that's competitive, more competitive than we've ever seen. And really, the rate environment now is what's allowing us to really draw the comparison to the mortgage refinance, and something that's maybe going to hit home a little bit different way with the consumer is just a better way to understand the concept.
Yeah. So before we get into some of the other commentary on the concept itself and retirement refinance, I think I did have kind of an aha moment. It was at one of those conferences. We were talking with an advisor who's had a tremendous growth in his business over the last couple of years, and he said one of the things he's doing now at seminars is actually talking about this concept, which he likes to ask people, hey, have you ever thought about or actually refinanced your home? And most hands go up, and usually people know when they did it, what their rate was, and what it went to. And in some situations, they had a 30-year mortgage. Maybe they'd paid for 7 or 8 years. Then they were actually getting another 30-year mortgage, but with a lower rate. Why? It's obvious to some of us, to save money, right? So then they have less cash flow going out, maybe a lower payment, but that's not always the case. So we're going to talk a little bit about, when it comes to retirement refinance, why do people refinance their home? And I think the conversation is easy for people to connect with. They know why they do it. They usually know when they did it and what their rate was. And it's easy to compare that back to, in the retirement side, why would we want to refinance certain other vehicles in a higher interest rate environment?
Absolutely.
So let's look at this here. I think it's interesting to look at, we know why with refinance. Let's just look at over the last 30 years, maybe the mortgage rate environment, right? Something on the insurance side we maybe don't talk about a lot, but I think it bears a lot of interest right now. So if you look at just the last 30-year fixed mortgage interest rate, you see a couple of major dips. So if we were going to talk to a consumer about refinancing their home, you probably wouldn't have done it back in 95 when rates were at 9.2, or even currently where rates are closer to 6.6, according to this statistic from Freddie Mac here. You would have rather have done it when you had dips. And you see that in 2000, 2021, 22 and 21. You see that a lot more. So what does that mean? Well, as you can see, this is when you had the mortgage refinance booms, the years during those dips. And that makes sense, right? Because people
Oftentimes it was when we were in a higher interest rate environment and rates had decreased, right? And that's the visual we're looking at here is really that refinancing activity, and it ramps up pretty quick as we see some of the decreases in the rates. And so you mentioned some of the consumers and being familiar with this concept and refinancing a mortgage. Oftentimes they've done it more than once, right? And in some instances, they were going from a 30-year mortgage to perhaps a 20 or 15, and their monthly payment was staying the same. So real value to these consumers as they're able to refinance their mortgage.
Yeah, great point. And if you look at this slide, I mean, obviously when times where rates were in different places, there still were some refinance activity going on, but you saw these big spikes. And I think that's a direct tie into the rate environment. So that's kind of what we're looking at right now, with the timing being a higher interest rate environment. And, you know, Brandon, it's funny. I remember quite vividly just a few short years ago where we had been in a consistently low interest rate environment. And we had some agents that had clients with policies at a 3.5% fixed rate that were a little long in the tooth, well out of surrender. But we didn't have even a better place to go then. We didn't even have fixed rates better than 3%. And now we kind of laugh at the idea of, well, only 3%. Now we have MIGA rates, 5, 5.5, even higher. We've had over 6% fixed rates. Par rates have increased, payout factors have increased, a lot of things we're going to talk about in a moment. But interesting to say, now really is a unique time for us to be talking about annuities.
Yeah, in the the 10-year Treasury, we're looking at it. That's what drives a lot of the pricing of these products that we position, right? These solutions that we provide, kind of hovering around that 4% mark. Last week, dipped under 3%. But my point being, product is still competitive right now. But how long is that going to be the case, right? We're seeing volatility in the marketplace. One of our index partners, Jeremy Siegel, I mean, he's sounding the horn, calling for a Fed emergency 75 basis point rate decrease. And so the time is going to be limited in this opportunity on some of the in-force contracts that we're going to talk about. But this has still been a booming industry. We've been positioning products that are even coming out of the surrender period now, and it's worth a review every single one of them.
Every single time. Yep, I agree. And I think when you talk about what you just went through, it's interesting to me because we were in such a low interest rate environment that it seems like we've came out of that lower time frame. But I'm not trying to predict the future on where rates are going. I feel like we're hearing more about rate cuts versus more rate increases. So if we're going to have rate decreases and pullback, who's to say we may not have a time like we have right now in the future? You saw some of the hikes on the previous slide. It took some cases 10, 15, almost 20 years to get back to an equally like rate environment. So that's why we're saying, hey, right now is a really good time to focus on this concept. And again, not trying to predict the future, but from what we've heard, looking at this slide here from Moody's, it does look like the longer term outlook for the 10-year Treasury is more like flat to lower, gradually lower. Maybe not a sharp decline, but we are at a really good time to have this conversation right now.
Absolutely.
And this was interesting too because we looked and we found some other graphs and slides, and some of the forecasting models even show a little bit more of a dramatic decline. So
Yeah.
we'll have to see how that plays out.
You got people calling for maybe perhaps even this year, it's August, three rate decreases before the end of the year. So no one knows, to your point, exactly what the Fed's going to do. But certainly we're not going to stay right at this 4% mark in terms of where the 10-year Treasury is going to lie for us.
Exactly. So, Brandon, let's outline what we mean when we say the $1 trillion opportunity a little bit, right? So we know we have the best long-term interest rates in the past 20 years. We just outlined the rates, all kind of came down and then have spiked back up in a pretty quick fashion.
Yeah, I would agree. And fixed index annuity sales really were taking off back in 2012, right? I wasn't here. You were doing case design in 2012, and so you were a part of this growth in our business. And we're seeing some of those contracts come out of the surrender period. And I think something that's worth noting that maybe hopefully is a learning opportunity for everyone is these carriers are pricing products based on the surrender period, right? So they're buying their fixed income components for the duration of the contract, and they're a little bit harder to price as they come out of surrender. And so just an additional opportunity as some of these do come out of the surrender period, they're renewing at a little bit lower rates, which right now is great because of the rate environment we're in. We have better solutions and alternatives.
That's right. Yeah, and we're seeing that. We're seeing 10 and 12-year contracts written 10 and 12 years ago that coming out of surrender, just even if they didn't reduce par rates, we'd still be in a much better position. And many of those carriers, to your point, are pulling back when they get out of surrender. And so that's really important.
Yeah, we talk about the variable annuity marketplace, right? Markets at or near all-time highs. A lot of these VA books have done well. They've done what they've been positioned to do. So again, an additional opportunity. We have some of the MIGA books that are coming due, whether they were 3, 5, 7, 10-year contracts. Those are worth a look, absolutely, just based on where rates are, whether it makes sense to stay in one of those fixed type products or look at something fixed indexed. Two different options. And we've seen a lot of evolution in some of the index design and some of our partners on the indexing side to really provide some of these smart beta strategies. We still have S&P cap strategies, which are, I'll say it, priced very competitively as well. But some of these alternative options that we're seeing, the 100, 200, 300 plus participation rates all uncapped and on really sound index strategies.
We also, we're going on a couple of years since we started to see interest rates creep up, kind of over those key numbers, 3, 4, even 5% there. So you're already seeing some of the 2-year and soon the 3-year fixed, MIGA rate products are going to start to come out of surrender as well. So it's even in the short cycle, we're going to start to see that. And interesting slide here from LIMRA, right? The trillions of dollars that are out of surrender currently, and you can see now 31% currently in surrender charge, but about 70% out of surrender in the variable marketplace. And to your point, a lot of variable annuities are tied or were sold with an income benefit that may or may not still be needed by the client.
Yeah, yeah. Again, just a great time to go and revisit some of those contracts. You're talking over $1 trillion that are out of the surrender period. I mean, talk about a favorable way to get in front of a client right now. And I think what's worth pointing out is some of these contracts that are in the surrender part, it's in the surrender period, right? Carriers are offering these premium bonuses because they're aware of the opportunity. They're able to really offset surrender and even MVA at times with day one premium bonuses and give the client more upside with better alternatives and new product solutions.
Yeah, good point. And I think that's why you're seeing that compounding effect slowly but surely over the last 10, 15 years. And now it's accelerated by the current interest rate environment. So what ideally are we looking for? What kind of client outcomes are we looking for if we're going to have this conversation and look deeper to see if it's the right contract or if we should be looking to refinance or reposition a current annuity contract for a client?
Yeah. Better client outcomes, absolutely. Just in our experience right now, and give it the product landscape, right? It's the 10-year Treasury that's driving the pricing of these products, and so right now there's more yield for some of the carriers to be able to offer more favorable rates, higher guaranteed income, higher payout factors on guaranteed income solutions. So we're seeing a lot of these replacements that we're doing ultimately lead to better client outcomes, right? And that's the whole point of the exercise is we're seeing a lot of increases to income right now, whether it's a variable annuity being reviewed and repositioning into an FIA or just pure FIA to FIA, both in the surrender period and out of the surrender period. Oftentimes we're increasing a client's income, lowering fees, and certainly every time protecting from downside market risk. So there's really a lot of reasons we should do these reviews. And again, it's putting more money in the client's pocket and creating those better outcomes.
I think there's always an example or two that pop into my head. And as you were talking about that, I remember quite vividly, very recently, I think in just the last few weeks, we had an agent who brought us a potential policy to consider an alternative for. And the current annuity contract was a single life payout generating $17,000 of annual income. And with just going through our process to look and say what else is out there, we were able to provide not only $19,000 a year guaranteed income, but on a joint life basis, right? So we took them from a single life payout at $17,000 to joint life to include his spouse, in this case, his wife, and have a higher payout. Isn't that right?
Yeah. And how awesome is that for the advisor to be able to have that conversation with their clients? At the point in time when they wrote the contract or whomever wrote the contract, single income was the need, right? And oftentimes it's for a younger spouse that's in better health. And just from a pricing perspective, pricing and planning perspective, the single income was where we landed, right? But being able to cover the joint lives, I think is powerful, and being able to do it and also increase the income. I mean, it's awesome to get to talk about.
So one place, if I'm listening to this, I'd be thinking, okay, anytime I have a client that has a product that was positioned for income and income's still the goal, let's just see if we can provide a raise in retirement, right? Let's just see if we can go back to the drawing board and have our team, not the advisor, you can just send it to us. We will go through that process and we will try to find out if, oh, hey, here's a different payout factor. Here's a different carrier that maybe didn't exist or wasn't in the position it is today when you previously wrote the last contract. But if we can give our client a raise in retirement for money they have earmarked for income, that added cash flow can be a significant benefit to the client.
Yeah, and with these higher rates, we're just I think inflation's a buzzword right now, right? And so cost of goods have skyrocketed. And so to being able to keep pace with inflation in a way and provide some of those raises, I think is so powerful just for the advisor to be able to have that conversation. As cost of goods have gone up, if we can increase in income, that could very much make a difference month to month.
Yeah, I think that's a great point. And I think we're seeing two things. We're seeing product innovation, but we're also seeing carriers now say, okay, we understand it is in the client's best interest to evaluate existing policies and perhaps try to reposition. So one of the things that we've noticed, and even very recently, is last couple of weeks, carriers are constantly tweaking or changing some of their maybe suitability guidelines, right? Or maybe opening up or broadening the opportunity to take on business that might already be with a different insurance company to move it to another for the sake of a better benefit.
Absolutely. And from a best interest perspective, you can't ignore it, right? Because product is unequivocally better right now and priced more competitively than it's been written in years past. And so just from a best interest standpoint, the carriers cannot ignore the opportunity that is right now in repositioning some of these existing contracts. Again, whether they're in or out of surrender, they've really had to loosen up some of the typical guidelines that they've had because we're in uncharted territory in where rates are and how product is priced.
Yeah, that's right. And so, that's a lot for any agent or advisor to try to remember. All the different carriers, all the different guidelines. Right, that's a really good reason to have the right partner on the back end, because I know we have our own processes in place, but we know that, right? So we know which carriers will accept which type of business. We know which products might be a better fit. But that's a big part of the process that we started out having a process, but I think over the last year or so, we've really fine-tuned that, right? So maybe talk a little bit about our process internally, what we do. So if I'm an advisor and I have 100 annuity clients, all those policies, some are, younger than others, but those policies are maybe 5 to 10 years, long in the tooth or out of surrender. What should I do?
Yeah, good question. So number one, it's a lot of work, right? It's a lot of paper, it's a lot of documents, and oftentimes it's easier to do nothing rather than take an action and doing something. And so we really want to be a good partner and help with capitalizing on this opportunity. So mentioned earlier, this is not a new concept to us. This is something we've been talking about for a while. This is a process we've had for a while, and we've been using, we mentioned Morningstar and their annuity intel reports. We use tools to kind of unwind and dissect some of the existing contracts and variable annuities, and so we're able to really put together an apples to apples comparison as to what's maybe in the client's best interest.
So talk me through that. So out of every case that might come in, how often do you think we're finding a better solution, or how often are we just helping the advisor go back to tell the client, hey, I evaluated the landscape, you're in the right product, stay where you're at, but at least how reassuring is that, right? That's still a good
and that's
outcome.
something you should be doing as an advisor anyway too, right? And so I think right now, it's 2024, and we've shown the 10-year treasury and how product is kind of priced, and we've mentioned that countless times now, and so more often than not, we're finding better alternatives. But it's not always the case. Oftentimes, there are some of these variable annuities, albeit high-end fees, but income guarantees can be competitive. Markets at or near all-time highs. So from a cash flow perspective, these contracts have done what they've supposed to, what they're intended to do, right? And so oftentimes, especially from an income standpoint, we can find higher or greater income guarantees, but there are instances where the answer is no. And again, we do a lot of that work for you and put you in the position to have that conversation with your client, whether it's positioning the better solution, call it 60 to 70% of the time, but there's that 30 to 40% of the time where you're having still a favorable conversation with the client and just reassuring them that what you've done was the right solution at the time and still is.
Yeah, no, and to me, that's a great outcome either way. Even if you just have a client review coming up, we're able to say, hey, you're in the right contract. I've already looked. I know you're probably doing some homework on your own, or hearing from your neighbor, your cousin, or your friend that there's a new product that exists. We've done the homework. You're in the right spot. I think that's a good intended outcome. And a big part of it, what you just mentioned, I want to reiterate it, we're using Morningstar's annuity intel as well. So it's not just our team. It is our team. We know the business. We know the different companies and the product landscape. But we're also using third-party documentation. So for those that are keeping client files and all the records that they're supposed to be keeping and need to drop some additional documentation into the file, this wasn't just because I thought it'd be a good idea to move. That's a good piece of it too. But it's going to be, you got the documentation from Morningstar. Here's what they had. Here's what we went to. Here's why it made sense for the client. And that's, to me, that's a big benefit on every replacement, and something that we do offer as well, because our intention is always to put the client in a better outcome. But oftentimes, too, outcomes change.
Right.
Or the intention of the product might change. I think one of the places we're seeing a huge opportunity right now is for contracts that are out of surrender with rider fee drag for rider benefits that are no longer really the intention of that asset. How often do you think we're seeing variable annuities or other index products with an income benefit tied to it, and quite frankly, it's not going to be utilized?
Yeah. What I think we have a percentage, right, of how many variable annuities have an income rider that aren't triggered. You look at some of these, whether they're non-qualified assets and they're interested in the tax deferral and they're in a variable annuity with an income rider. Oftentimes, clients 50, 55 when that happens, whether, again, non-qualified or IRA dollars, they enter retirement, that distribution phase. Maybe they've had another job, remarried, things change in people's lives, and they may not need that income guarantee. And
Right.
again, these products are kind of, that the income's expensive for carriers, right? And so oftentimes, if somebody goes to trigger a lifetime income rider, we can increase the income, but oftentimes there's no need for the rider. And so we have better solutions as well in order to lower fees, protect from downside market risk with the market at or near all-time highs, and still provide the upside growth.
Yeah, and just one other thing to think about. Things have changed from a regulatory landscape. Secure Act 2.0, getting rid of a stretch IRA, having a spend down for non-spousal inherited IRAs. Things have changed. And there's policies that were written well before those regulatory rules had even occurred, right?
Yeah.
So there aren't too many anymore, but there are a few carriers, right, that'll still allow non-spousal inherited IRA conversations. Another interesting comment or concept is always non-qualified stretch business.
Right.
I mean, there's some unique nuances that you need to really think about when you're either repositioning, not just maybe an in-force policy, but what happens at that wealth transfer stage.
Yep. Which is too an additional, talk about generational planning and the opportunity in generational planning. I mean, that's, I think the number one solution that I'd be trying to provide is just some of that, it's a tax conversation, right? How can we do this in the most tax efficient manner? And we have non-qualified stretch options, the non-spousal inherited IRA. We have carrier product solutions for those concepts. We can automate the spend down and the RMD requirements. And so we do have awesome solutions for those as well.
That's great. And I think, so if I'm listening to this, I'd be thinking maybe in 2 or 3 phases. One, perhaps if you're an agent that has a Medicare book of business or a different book of business that maybe haven't talked about annuities before, an easy place to start is, hey, if you have an in-force annuity, I'd be happy to give it a complimentary review, see if you're in the right place, and if not, maybe find a better product, because products evolve just like everything else out there. I think that's a really easy way to get the information, send it to our team, have our team be able to do a lot of the back-end legwork to figure out better product, does it make sense, Morningstar Annuity Intel tools, the things that we rely on to try to help decipher, A, what do they have, and B, should they make a decision to consider a different product. So I'd be going back and thinking, who have I not talked to that might even own contracts that I should be offering for a second opinion? And secondly, too, look internally at your own book of business. And we know for a fact, because we recently talked to an advisor who had well over 150 active in-force policies. And part of the reason why they didn't dive in is because, A, where do you start? And B, that's a lot, like you said, there's a lot of paperwork, that's a lot of work. But we can do, not saying we can fill out the apps for you, but we can do a lot up until that point for you. The homework, the back end, maybe even a prioritization of which clients to start with.
Yeah, and I think to your point, your book of business better than anyone. Give us a place to start in some of the reviews. You know your clients better than anyone. You know who has some of the existing contracts or policies. You can ask those questions. Give us a starting point in some of these existing contracts, and we'd be happy to do our complimentary review and just move forward with the process.
Oftentimes, we just need to know the date of birth, the purpose of the money, and the details of the existing policy, which we can usually get from the statement or on our own. So that's really the process. So, when you think through it, Brandon, right now, in my mind, is the best time to be in the annuity industry. And as long as I've been doing this, 15 plus years now on the annuity side, it's a really good time with the rate environment, markets near all-time high. We are in an election year. There has been some heavy market volatility the last few weeks. Safe Money Solutions are in a very good place to be able to provide that consistency and the guarantees consumers are looking for at or near retirement. So it's a really good time to be having these conversations. I'm guessing the regulatory landscape's not gonna ease up. There's just going to be more confusion built in. So having some contractual benefits on some of these policies make a ton of sense. And really, that's what Senior Market Sales is here to help you do. We're trying to help all of our agents really have the best premier health and wealth platform behind them to make these processes and these different ways they can add value to your client easier and more efficient for you, because that's kind of the name of the game for us, right? We're looking for efficiencies and ways to help you grow your business.
Absolutely. We're here in the SMS Health and Wealth Studio, so we feel we've created the premier health and wealth platform. We're proud of it, and talk to your marketing consultant if you have any questions.
That's exactly right. And one of those questions should be, maybe about a new piece that's actually behind me over here. We did come out with a new white paper called the Retirement Planning Mind Shift, New Thinking for Growth in a New Era. I think what we tried to do, and a big part of the timing is because of what we just laid out. We have a lot of people entering retirement, landscape's changing, the need and the want of an advisor is changing, the partnerships are changing. So it's an exciting time, but you need to be paying attention to what's going on around us. We came out with a white paper to help articulate that from our perspective, give you some things to think about, and we tried to find maybe 7-ish different paths to growth for your business. And you'd have to prioritize those because there's a lot of opportunities again. But looking through the 7 paths of retirement, perfect time to think about all the different growth paths for your business. We can help you knock down or tackle one at a time each one of these 7 different paths. So please do us a favor. You got the white paper, the 7 paths to growth in the retirement era. A lot of great information. Start there. Reach out to your marketing consultant, and let's talk more about how we can help you grow your business.
Thanks, John.
Thanks, Brandon.
Thanks for joining.